Good morning, everybody. This is the live market open. I'm Yohay. I'm a Forex Crunch and Market Movers podcasting. The show, as usual, for FX Rate. Hi there, everybody. Hope everybody had a nice vacation. The last ones of you have been on holiday in the United States on Labor Day, and now we're back. As usual, we'll cover recent developments in markets, what's going on, cover charts and levels, focus today on one currency pair, dollar CAD, do a preview for the main event of the week, the ECB, the European Central Bank. Keep you up to date also on what's going on in the US elections. It's after Labor Day, there have been some developments, and as usual, preview the next week's events. So it's a jam-packed show. We also had quite a few movements in markets. Right, so good morning, Luca. Good morning, Adinda. Good morning, everybody. Okay, so what's going on in markets? Bottom line, the US dollar is falling. Okay, we had a series of weak data. Non-farm payrolls came out worse than expected, and especially the ISM figures. We'll run over that. I would say forget about rate hike. Chances were low anyway because of the elections, and now they're even lower. Oil prices, we had some rumors about OPEC meeting, an OPEC, non-OPEC meeting, some kind of deal to freeze production, cut production, but there's so many doubts about it. We had a run up in oil and then a run down. Trump is edging closer to Clinton. We'll cover that in the special segment. Markets could begin paying attention to the US elections quite soon. And no more vacations, as I mentioned. Welcome back to school. Another interesting development. Regarding the vacations, that means that volume is 100% normal, even more than normal, and lots of events also going on in markets. No more sort of these air pockets. No more, probably no more nonsensical break of technical lines, okay? Brexit is back on the table. Also, the UK government is back from the vacation, and they are not sure what they want to do with Brexit. What does it actually mean? The Prime Minister said Brexit means Brexit, but what does Brexit mean? Less immigration, but less trade. They want to have the cake and eat the cake and have it all. That means less immigration, but free trade. But anyway, that's another thing on the agenda. In the meantime, UK figures are looking quite good. Another big another big central bank meeting this month is the Bank of Japan. In his last speech this week, Bank of Japan Governor Kuroda basically left all the options open, didn't say too much. And another central bank, the Bank of Australia, Glenn Stevens made his last rate decision. He's being replaced by Philip Lowe, and he did not rock the boat. Very balanced statement, worried about the exchange rate, but sort of okay about the economy. Okay, so quite a few developments in recent days. Let's talk a bit about data points. Beginning from the American data points, which were bad. Okay, so of course, the king of economic indicators, the US non-farm payrolls, it missed with 151,000. Good morning, Ed, as well. That was below expectations of 180 and well below sort of figures we were looking for to justify a rate hike in September. That means above 250,000, right? And also wages missed. So if the economy is nearing full employment, we should expect less job gains, but we should expect also pressure on wages, right? Upward pressure. But also salaries disappointed. They went only 1%, 0.1% to the upside month over month, and 2.3 year over year. Sort of a setback, falling back to previous ranges. We already broke above 2.3. Anyway, it was quite disappointing. Also, the average work week for the report in July, it went up above the normal sort of dead person's heart rate of 34.4, went to 34.5, and now it fell back to even 34.3. So a set of disappointments there. We did have a mixed reaction. Some analysts said it doesn't matter. The Fed gave us a big signal in Jackson Hole that it's going to raise rates in September. The case for a rate hike is strengthened, said Yellen. Fisher said it is consistent with a rate hike in the month of September. And maybe this report was actually good enough. But so there was, the dollar fell, then rebounded, and then sort of began falling once again. But the final blow, I believe, came yesterday, first day after the vacation for American traders. we had the services sector indicator, the ISM non-manufacturing PMI, and that really plunged. It fell to the worst level since January 2010. Okay, so when the recovery only began. So the services sector gauge, the ISM non-manufacturing PMI, came out at 51.4, hardly growing. The services sector, the biggest in the United States. And I remind you that beforehand, back last week ago on Wednesday, we had the ISM manufacturing figure, also providing a bitter disappointment, falling to 49.4, under 50 points at recession levels. Okay, now it's the manufacturing sector, it's smaller, it was ignored at the time with the bad NFP, and of course, yesterday's bad services sector indicator, that's already big, okay? Other data figures, basically in the UK, it's the total opposite. All the PMIs were actually great. So PMIs, again, these are soft data, these are surveys looking towards the future, not what actually happened, but what important, influential people think will happen. Okay, so also the services sector figure jumped back up from contraction to expansion, 52.9. Also, the other figures were great. 5-point jump in manufacturing and almost growth in construction. Construction perhaps is now the weakest link, but still a lot more optimism in the UK. Totally different picture than just 1 month ago. So Brexit means Brexit, said Prime Minister Theresa May, and this maybe markets think it will never happen anyway. Chinese PMIs were finally balanced between growth and contraction. They rocked the boat less than I had expected. We had sort of the expected outcome. The government figure came out better than the independent one. So it depends on who you want to believe. We didn't really have the market impact. In Australia, we had lots of figures. We had misses on retail sales and capital expenditure. Also tonight, a miss on GDP on the quarter-over-quarter, but a better than expected figure on year-over-year. So Australian economy still doing well. Remember, Australia did not experience a recession in the past 25 years. In Canada, we'll focus a bit more on Canada. Things are a bit more complicated. So we had better than expected GDP back in for the month of June, okay? But it was a bit worse beforehand. Blame it on the wildfires and blame it on Canada. Okay, in the Eurozone, we'll focus on that, of course, in the ECB preview. Inflation came out worse than expected after a few stable months. We had no advance in, the headline inflation got stuck at 0.2, blame it on oil prices, but also core inflation at 0.8 is a setback, is a retreat from 0.9, already reached 1% at one point, so this should influence the European Central Bank. And in New Zealand, things are looking good. A third or second consecutive big jump in milk prices, 7.7 reported this week. So this commodity currency is looking good. Okay. And now let's go to the charts. Let's focus on technical support and resistance lines for all our major, minor, and cross figures, and also on crude oil at the end. So let's start from the top. The world's most popular currency pair, euro-dollar. So currently, this pair is trading at 112.40. Big leap there following yesterday's poor ISM non-manufacturing PMI. Support is just around this line at 112.40. So the pair did settle above support, but let's see if it holds on to these gains. Today, there shouldn't be anything to push it off. If it does fall off, further support awaits at the post-Brexit high level of 111.90, and this is followed by 111.15. Okay, to the upside, we have the veteran line of 113.35, which was the bottom end of a high range when the pair traded, and the pre-Brexit high just on the night of 114.20 is resistance above. Okay, pound dollar cable, quite a ride, 134.07 as we speak. Support there at 133.60. You can see that the pair struggled to break above this line on this channel. It had this narrow channel here. We eventually broke above this, very nice series of higher highs. Anyway, further support to the downside 132.50, and further below I can see support only at 130.60. If we look to the upside, we'll need to zoom out to the daily chart on cable and pound dollar, and here we can see the post-Brexit high. Look at this big Brexit crash. The post-Brexit high of 134.80. We're not that far away from that point, okay? So this is a very important line to watch, because above this line, it's only somewhere like 138. I mean, the pre-Brexit low of the year, okay? So cable is certainly at the very high end of the wide range we've seen recently. Dollar yen had quite a fall tonight, I mean, the Asian session, morning in Asia, night here in Europe. So we had a reaction to the poor US figures, but the first reaction was quite limited. Actually, non-farm payrolls, it didn't hurt the dollar yen so much, but yesterday we already had a big fall and then an extension just sort of in the Tokyo session without any indicators. I still look at this line 101.50 as some kind of battle line, some kind of pivot line to the upside. We should update this line I had here isn't that relevant anymore. Sorry. Anyway, 103, I would say the round number here provides now, it switches from support to resistance. If we zoom out just a bit, I would say 104. I thought it would be around a nice number, but actually I had a few moves above 104, so I would say 104.50 isn't a strong line. I would look more at 105 and 106.90 as high levels up there, but so far this high, you can see this is a head and shoulders pattern on dollar yen, 104.30 and 103. So 104.30 as the top of the head and 103 as the shoulder line. Okay, so further below we have 100.70 worked, and it's both support and resistance. Of course, the key line to the downside is 100, and it's followed by 99.60. Dollar CAD had quite a ride, well, to the downside. A very nice finding here, support at 128.30. I always say that the Canadian dollar CAD is sort of overlooked, undervalued, but it has nice technical behavior. Look how it got stuck at 129.10. This isn't a line I drew this morning, but actually a line I had here from beforehand. So very nice technical behavior. 108, 128.30, followed by 127.50 to the downside, 129.10 and 130 to the upside. High resistance at 131.40. If oil prices fall, we could see dollar CAD bounce back up, but currently the US dollar is selling off. Australian dollar finally managed to rise. A very hesitant rally, very hated rally, as some people talk about Wall Street, for example, the most hated rally, but figures have been positive, including the GDP, and more importantly, the US dollar has been weak. 76.60, some kind of support. We can see it isn't that strong. 76.40 is another line, and 76. Really key support is at the round number of 75. To the upside, if we have an extension of the current move, then we have 77.73 to the upside, and 77.40, maybe 77.80, and 78.40 is the high level of this year as the high level to the upside. Kiwi dollar, here we are finally. We had a series of false breaks above 73.30, 73.40, this range, and now we made a clear break to the upside, trading at the 74 handle, above 74, above the round number. The next level, of course, to the upside is the round number of 75. Let's see if we hold up to these gains, because breaking to this ground has been quite a struggle. 73.30 remains the line that I'm looking at. And to the downside, it's a bit more choppy. Let me update this line. I would say that 72 is a nice line of support, followed closely by 71.60 and 70.50, which used to be a double top. Okay, I'll look to see if we have any questions before I move to the other currency pairs. So good morning, Luca, once again. Logically, Carney, should acknowledge the good UK data today and move to wait and see mode. Do you expect any fireworks from him trying to hold the pound down? Well, Carney, now I'll answer this question later on. Let's complete the technical move. So we covered the euro, pound, dollar, yen, CAD. Now let's talk about the Swiss franc against the US dollar and then move to crosses. 97 is the current level of dollar Swiss. 96.40 remains a clear separator of ranges. You can even, well, you can see it worked on both directions. 95.50 is further support to the downside. Resistance there at 98, maybe a bit above 98, and higher resistance at 99. Always remember the Swiss National Bank likes intervening in markets. Euro Swiss, that's where they do intervene. Currently slipping to the bottom of the 109 handle. We had it trading for a long time. Look at the narrow ranges. We reached 110 and we're back down to 109. 108 is support to the downside. I have many lines drawn here, but this pair, this cross is very choppy. I would say the very bottom line in the sand is 107.60. And of course, the Swiss National Bank would like to see higher levels for this pair, weaker levels for their franc. Anyway, ranges are limited. Euro pound, lots of excitement here. So the pound rally is reflected also against the euro. The euro did some catching up against the US dollar, but as you can see, the pound is currently king. And we'll answer the question about Carney soon. 83.90 is the current level. Some resistance there at 84.40. Not such strong lines, I would say. This pair has also become a bit more choppy. 86, that's already much stronger line. Work both the support and resistance, and it's now way to the upside. 83.30 is support to the downside, followed by 82.20. Okay. Euro yen made a nice move to the upside. Remember, the yen was much weaker a few days ago, so the move we're seeing here reflects the re-strengthening of the Japanese yen more than anything else. Anyway, we made it all the way above 116. 114.50 is still some kind of resistance. I would say that 113.80 is some kind of support. This pair is closely watched by institutional traders because these are very highly traded currencies, but less by retail traders. Anyway, let's add a few lines here. I don't follow it that closely. 115.80 to the top side before 116.40, and current ranges are, and if we break under 113.80, I would say 112.20 is very low support to the downside, and just before that we have the level here at 112.80. Okay, and this is a currency less watched by institutional traders, but more by retail traders. Pound yen, lots of pips to be made and to be lost. So we fell to much lower ground, closer to the levels seen post-Brexit. And now things have rapidly changed. Okay, so we can see here, this is a daily chart. We got close to, now we have actually double bottom there at 128.50, but a big bounce from there, already some 800 pips. 140 to the upside remains a round and important line. 143.40 is high resistance, and ranges here are a bit wild, I would say. Okay, and let's look at the last instrument for now and then answer a question, maybe more questions. Oil prices, we talked about the madness in oil prices. Here we are, we had in early August, WTI crude oil traded under $40. Remember that? Around $39, went all the way up to 49, and then began falling down, sort of ebb and flow. In recent days, we've seen this big jump from around here, 43, all the way to 46.50 on those rumors, and back to the previous range. I would say that $45 in the middle of the range between 40 and 50 is sort of a magnet for the pair, and we might get stuck around these levels until we get some more clarity. I don't expect any deal between Russia and Saudi Arabia and Iran and all the other countries. Anyway, important lines to watch. 47. Should update this as well. 46.50, 48.30, and to the downside 43. Okay, if you are trading WTI crude oil, of course, if you're trading the Canadian dollar, this is an important chart to watch. Okay, now let's look at the questions. Oh, okay. So let's repeat Luca's question from before. Logically, Carney should acknowledge the good UK data today and move to wait-and-see mode. Do you expect any fireworks from him trying to hold the pound down? Well, I expect Carney to, first of all, pat himself on the back. I'm not kidding. That's what central bankers do. So what happened is that we had Mark Carney at Bank of England react to very poor survey data, very doom and gloom figures, and they decided to introduce a comprehensive stimulus package. This package consisted of cutting interest rates, adding QE, adding corporate QE, making other adjustments, and hinting about rate cut in November. Since then, hard data, retail sales, jobless claims for July post-Brexit, all of these figures have been really good. And also the soft data, also the survey data has significantly improved. So you'll be asked, okay, but you said, didn't you react too soon? And he will probably say, no, it's thanks to our actions that the economy is actually doing better. At least there's more optimism. I don't think he wants a stronger or weaker pound at the moment. It doesn't matter that much for the UK. In theory, most countries want a weaker currency to boost exports and to lift inflation. But the Bank of England still expects to squeeze, doesn't want really strong inflation. And yes, it does help exports, but some of these exporters actually import goods before they export stuff. So the picture is a bit more mixed. He wouldn't like a weak currency, wouldn't like it to rise too much. So I think he'll dodge any currency-related questions at the moment. Hope this answers the question. I think I'll try to waste time at least until the next rate decision in November, which also includes the Bank of England's quarterly inflation report. So in the yes, it's testifying today. There's a rate decision next week, and then he might sort of give some general details, but the big fireworks, I think, we'll wait for November. Okay, so let's continue with what I have in store for you guys. Okay, so let's talk about other events coming up. So as we already hinted, UK inflation report hearings at 1:15 GMT. We have beforehand UK manufacturing output. Not that important because the manufacturing sector is small, but still it's interesting because it's figures for July. Let's see if we had any reaction, not in surveys, but in actual production and actual output. We'll have that at 8:30 GMT. More important decisions, we'll focus on that in the special segment, Canadian rate decision at 2 GMT. We also have a speech by Esther George. Remember, she's a hawk. If she'll talk about a rate hike in September, you should ignore because we know that's what she wants. She voted for a rate hike, but Janet Yellen and all the rest are against that, or almost all of them. US job openings for the month of July, a bit late because, well, July we know we had an excellent NFP, and since then August was weaker, so it won't give us the full picture. Final GDP from Japan tends to be highly revised, but I don't think it'll impact the Bank of Japan, but you never know, worth mentioning. In any case, tomorrow we have the Chinese trade balance. Remember, imports and exports are more important than the bottom line. So if we have a smaller surplus or a bigger surplus, it doesn't matter. We want to see more activity. That would be a good sign. More exports, more imports, more global activity. and less of those would be bad. European Central Bank decision at 11:45 GMT tomorrow, and the press conference, much more important because no change is expected, at 12:30. We'll preview that shortly. US jobless claims, as usual, every Thursday. And for a change, we have the oil inventories on Thursday at 3 GMT instead of the usual Wednesday at 2:30. And on Friday, we have UK trade balance. That has been one of the weaker points, and that perhaps could provide an opportunity for profit taking on the pound, because this it's a second-tier figure, but it has been worsening. It has been gaining more and more attention. So even if other figures are positive in the UK, this one could be negative. Okay, we have a speech by the Fed president of the Boston Fed, Eric Rosengren, at 11:45 GMT. This could be important because he's more in the middle. I expect him to bury the chances of a September hike. And the Canadian jobs report, again, we'll focus on that on our special Bank of Canada, as a special dollar CAD segment. Okay, and this is the segment for dollar CAD. Dollar CAD is now in focus for a host of reasons. It's still moving with oil prices, but less than beforehand. So if we see announcements from Saudi Arabia, Iran, Russia, or inventories, we usually expect some kind of reaction in the Canadian dollar, but these reactions could be limited, okay? They could have more impact if they go with the trend, but not against the trend, okay? So it's not, oil prices do not control the Canadian dollar. They have some influence, but do not control. Okay, it's important to remember that the economy was hit by those wildfires in Fort McMurray, but it recovered afterwards. So on a quarterly basis, the economy squeezed annualized 1.6%, which looks quite bad in Q2. But in June, when these fires were won over, the economy did recover. So these could be mixed figures. It's important to watch that. The dollar CAD, the Canadian dollar, did enjoy the weak US non-farm payrolls because it sort of lowered the chances of a rate hike, and that means more economic activity in the US. Absurdly, it's good for Canadian demand. Canada is the only Western government, well, we can count Japan, but in North America and in Europe, that is busy with fiscal stimulus, something that will be a big issue tomorrow in tomorrow's ECB meeting, something that is really lacking in Europe. The Canadian government, led by Justin Trudeau, is going on a fiscal spending spree. It'll be interesting to watch more in the long term. Another thing worth mentioning that I didn't put here in the slide is that the government of the province of British Columbia, where Vancouver is, and Victoria, the west coast of Canada, they decided to add some property tax, trying to curb demand for the bubbling housing sector. It did cause lots of action in that local market. Let's see if that impacts the economy. So if you hear specific news about that, it's worth, if you're trading the Canadian dollar, it's worth following house prices in Vancouver. Okay, for more details now on what's really coming up next, today at 2 GMT we have the rate decision. I would say no changes expected. That's the easiest part to say. The big question is, what will they do? Okay, they want to see, like many other places, a transition from mining, let's say in Australia that is. In Canada, it's mining of oil, tar sands, and to other areas of the economy. This might be happening. The exchange rate is helping a bit, but perhaps not enough, not in the pace that they would like to see. The economy in general is stable. There are no inflationary pressures. So the weaker Canadian dollar did push inflation a bit higher, but still very much in control. No worries about that. Employment, we had a few disappointing reports, but all in all, the unemployment rate at 6.9% is not a disaster. Okay, so the Bank of Canada should sort of paint a balanced picture. Stephen Pelosi, the governor, is optimistic in general, positive. not very no doom and gloom. So we could have sort of positive statement, no hints about rate cuts anytime soon. The interest rate in Canada is 0.5%, and they said in the past that it could fall to minus 0.5 as an option. But I think that with experience from other countries regarding regarding negative rates, they will not be the next central bank to jump into that territory. Let's put it this way. Okay, also today we have the IVPMI. Again, this shows the relative strength of the Canadian economy. This Purchasing Managers Index shows growth. It was at 57, now expected to slide to 56.3. Very well into solid growth territory. And tomorrow we have the oil inventories again. Correlation between oil and CAD has somewhat weakened. Okay. Next up, Friday jobs report. It stands out this time because it isn't attached. It doesn't release at the same time as the US jobs report is released, and it has all the stage to its own. A bounce back is expected and much needed. So if we'll have another fall in jobs, it'll be very worrying because last time we had over 30,000 jobs lost reported. Okay, 18,000 are expected. Last actually 2 reports were quite weak. Again, if you see changes in the jobless rate and the unemployment rate, you have to watch out also for the participation rate. It might be mixed. And in Canada specifically, it doesn't only matter how many jobs were gained or lost, but the composition, full-time against part-time. Of course, more part-time jobs is not so good. Full-time jobs, of course, are more welcome. So if you have, let's say, 30,000 jobs gained, but we have out of these, I don't know, 40,000 part-time jobs gained and a loss of 10,000 jobs, that's actually bad news in the details, even if the top line is positive. Okay, just an example. Of course, there can be other compositions. Anyway, after a few bad months, we should expect a bounce in jobs in Canada. Okay, and before we move to the ECB, just to complete this segment about Canada, let's once again look at the Canadian dollar chart and mention the levels. So we'll have this thing complete. Very nice technical behavior there, 128.30 support, further support 127.50, and I would say 126.30 out of this chart. On the top side, 129.10, 130, and 131.40. One of the favorite technical pairs to trade, and a very busy week ahead. And also the whole month of September should be interesting. Okay, so this is the ECB preview. The European Central Bank, led by Mario Draghi, convenes tomorrow, September 8th, to decide on the rates. No changes expected in rates, although I've seen Citibank, I think they expect the ECB to cut the main lending rate from 0 to minus 0.10. Remember, what's negative is the deposit rate, okay? Deposit rate minus 40, and that serves as the limit for the ECB's bond buying. So the European Central Bank can buy bonds that yield up to minus 0.40. So if investors are paying the German government to hold their money, it doesn't mean that the ECB cannot buy these kind of bonds, okay? These could still be cheap. Anyway, that's what's expected. And there might be questions about whether the ECB has reached its limits on that. Okay, what else can we expect from the ECB? Well, inflation recently, as I mentioned before, is low, 0.2 headline, 0.8, and the core inflation. In this specific meeting in September, the ECB releases fresh forecasts. It unleashes these forecasts once every 3 months. It happens now. Let's see if inflation and growth targets are lower. There will be a question, what else can the ECB do? They're buying 80 billion euros worth of bonds and corporate bonds, ABS, asset-backed securities, you name it, every month. Lending money, paying banks actually to lend money, negative deposit rate, and it's never enough, okay? I don't think they'll cut rates further down because negative rates are hurting banks. Remember, banks rely on the margin between money deposited and money lent out to make money. And with very low and negative rates, it makes it problematic. We know there are banking troubles in Italy and also in Germany. Despite lending incentives, banks are idle. Well, they have some capital shortfalls and they don't know who to lend to. Okay, so there's a lack of trust, lack of confidence in the economies. Fiscal stimulus is needed. The ECB doesn't say it outright. It always asks governments to do more in general and talks more about structural reform, which is sort of very vague and general. We know that Germany has surpluses and it could certainly spend money. All in all, the ECB is a bit limited, okay? What can they do anyway? They can extend QE, their bond buying program, beyond March 2017. Remember, the original program was planned to end right now in September 2016. It was launched in early 2015. So they'll extend it perhaps by 6 months. And I think a more powerful move, something that will hurt the euro even more, is to extend it to infinity, like QE3 in the United States, to tell markets, we're going to buy bonds at 80 billion per month until we change our mind. But probably they'll have only a 6-month or maybe 12-month extension. They might change the rules regarding buying bonds. Currently, they cannot buy too many bonds that belong to one country or one specific issuance, have various conditions in order for them not to be not to dominate the market like the Bank of Japan does in Japan. And they might soften these rules, they might loosen conditions, also in buying corporate bonds, and perhaps introduce more small steps. They can do only small steps because they're close to their limits. That's why expectations are relatively low. But if they do surprise with a big rate cut, if they do surprise with even more QE, then the euro will fall. Okay. All in all, the euro is starting from relatively high ground because of the strength, the weakness of the US dollar. So we can expect various moves around there. Okay, so that's the ECB preview. All in all, no big moves expected, I would say. If we do have any kind of fresh stimulus or hints about big actions in December, for example, then we can have the euro falling. Otherwise, it'll chop around or maybe even rise just a bit, okay? But you never know with Draghi. Draghi did disappoint us in the last few meetings. He isn't the magician he used to be, okay? He seemed tired. He hardly moved markets. Volatility was extremely low during his press conference compared, of course, to the past. So I would say that perhaps this time will be different. That's, I guess, more wishful thinking because I'm a big fan of Mario Draghi and not necessarily reality. Okay, let's see ECB preview. Let's see if, before we move to the next segment, see if we have more questions. Lucas says, a bit puzzled how strongly the Australian dollar is underperforming Kiwi and even CAD. Yeah, well, still uncertainty about China. The RBA did cut rates and is expected to cut rates. I've also seen the relative weakness of the Australian dollar. I would say that during the second half of August, oil prices strengthened and that helped the Canadian dollar. For New Zealand, we had really good figures there. The economy in New Zealand is doing great. And 3 consecutive rises in milk prices. So these 2 other countries had reasons to rise, while data in Australia is mixed. Again, great country, 25 years without a recession, but figures have been mixed. Investment, capital expenditure didn't come out so not so impressive. Retail sales fell short. So yes, the unemployment rate is down, no recession, but it's a bit more complicated there. Another question here by FX Kamar. What do you think about dollar Swiss? I don't like the Swiss franc because the Swiss National Bank intervenes there too much, okay? In general, what we're seeing mostly with dollar Swiss is a reflection, sort of, if you wish, the dollar index, sort of strength or weakness of the US dollar. But from time to time, we have these violent interventions. So The dollar is currently on the downside. That means it's on the downside against the Swiss franc as well. So I expect that to continue. But again, Swiss franc is seen as a safe haven sometimes, and this S&B intervenes sometimes. So I would stay away. Okay, let's continue to the next segment. So, cover the ECB. You know what? Before next week's events, let's talk about another thing. So, this is an update on the U.S. elections. U.S. elections is a never-ending story, not only in this cycle, but also in previous cycles. It just lasts for too long. But anyway, we're currently sort of stepping up. The campaigns are, Labor Day is over. Americans are back from their vacations. The conventions, the RNC, Republican National Congress, and the Democratic National Congress are well behind us. These were held in July. We're already in September. Sort of quick thing on what happened so far. Clinton was always in the lead or tied, but in July, Trump did manage to catch up. Clinton was investigated by the FBI, and the Republicans had their convention, but then the Democrats had a successful convention, and more importantly, Donald Trump had a series of stupid things he did, big mistakes, bigly, if you wish, especially with insulting the family of a fallen soldier. And Clinton reached a lead in early August of about 8 points. But things have been changing now, very gradual changes. But now the markets might get focused. Why? Because the changes have become a bit more significant. And because, again, we're after Labor Day, markets are more focused in general, and the campaigns are more focused. So Donald Trump did change his staff. Most important change was putting Kellyanne Conway, a veteran pollster, and she sort of smoothed his message. He'll say he's not pivoting, he's tough, but anyway, they're a bit more intelligent, making less mistakes than they made beforehand. Clinton, again, has these email scandals, and the recent public appearances have been a bit weak, I would say. And it might be also, profit-taking, like profit-taking in markets, sort of the pendulum swings to the other side every once in a while. Anyway, polls have been tightening very gradually. Currently, according to various websites, it's 2/3 chance for Clinton to win. It was around 90% chance a few weeks ago. And in terms of national polls, it has been a lead of about 8 points. Now it's about, I would say, 3.5 points, okay? Real campaigning begins now. Remember, for markets, markets usually prefer the Republican candidate, more market-friendly, more business-friendly, good for Wall Street. But in this case, Donald Trump is anti-immigration, anti-globalization, anti-trade, and very, very unknown, very crazy, okay? On the other hand, Clinton comes as a sort of half incumbent, replacing president from her own party, Barack Obama. She's a very, very well-known public figure, very mainstream candidate. Even though many people don't like her, you can't expect too many surprises from her. Okay, so it's Clinton continuation versus Donald disruption, and I think we can have during the month of September more impact from those various opinion polls, from what Trump says, from what Clinton says on markets. Which currencies could benefit more than others? So again, I think markets do prefer Clinton over Trump. So Clinton, again, continuation, certainty. That means if this is only sort of the pendulum swing in Clinton, again, widens the gap in her favor, it'll be good for risk-taking for commodity currencies. The Australian dollar, perhaps currently, as aforementioned, the weakest link, the Canadian dollar, and the New Zealand dollar. And perhaps also the pound, not a commodity currency, but taking advantage of that. If we have Trump edging even closer and perhaps even leading, we could see a bigger reaction. Why? because so far Clinton has been in the lead, and having Trump leading, that would be a big change, a negative change for markets. This could benefit the ultimate safe haven, the Japanese yen. Also, the Swiss franc on the sidelines, and the euro could be a mixed picture because the euro did benefit last year from some safe haven flows. This isn't the case at the moment. Anyway, it would add Trump, but also many market participants. And this uncertainty also joins other uncertainties. Brexit, the fate of the Eurozone, China's slowdown, Russia, terrorism, you name it. Okay, so in case that Trump continues this trend, and we have a few more important polls this week, the week after Labor Day, then we could see perhaps safe haven flows related to the US elections. Okay, let's move on, or perhaps see if we have more questions. Yeah, you're welcome. Okay, no questions at the moment. Let's continue with next week's events. Nothing on Monday. Okay, very easy Monday, long weekend if you wish. No holidays, but no events worth mentioning. On Tuesday, we have the Chinese industrial output, important for the Australian dollar. And inflation in the UK, let's see. Inflation for the month of August, if it has picked up due to Brexit or not. Perhaps the British pound doesn't have such a strong impact. German zoo indicator, early but not always correct. It did improve last time, but it's still, German investors are not that confident, still impacted by Brexit, contrary to UK investors, which are more optimistic. I mean, they bounced back. On Wednesday, UK jobs report, jobless claims for August, and the unemployment rate and wages for July. Let's see if we have any Brexit impact. Again, the previous report was A-OK, and the oil report, as usual, crude oil inventories on Wednesday. Thursday is an extremely busy day next week. GDP from New Zealand very early in the morning. Australian jobs report, always key for top tier for the Australian dollar. The Swiss rate decision, the quarterly rate decision, they will probably tell us that they have decided to keep the peg. Sorry, they don't have a peg anymore. They will keep intervening in markets and keep their very negative interest rate of minus 0.75. Maybe we'll see some wobbles in the Swiss franc, but unless they, no big moves unless they really change policy, and that is not expected. UK retail sales, that's for the month of August. Let's see if the good trend from July continues. That means that that consumers are ignoring Brexit and just enjoying the good weather. And that was the reason, in theory, for the good retail sales report back in July. And of course, on the same day, the UK rate decision. We'll talk more about that in detail. But in general, no change is expected. The big move awaits us probably in November. It's a big day for the US economy. Retail sales and producer price index and industrial output. Retail sales is always the most important release because most of the US economy is about consumption. And if some people still have doubts about the rate hike in September, that could give an answer. But anyway, I think at this moment, it'll shape the message. If we have a good report from retail sales, it could mean a more optimistic message from the Fed regarding a rate hike in December. And if not, it'll be more doom and gloom. But I don't think it'll be a game changer for a rate hike in September, which is only 1 week afterwards, 2 weeks from now. Okay? And on Friday, US inflation and consumer sentiment. Consumer sentiment could be more important for politics. Okay, if consumers are more optimistic, it should be good for Clinton. If they're more pessimistic, for Trump. In theory, it reflects, well, it should also impact markets because higher consumer sentiment in theory means more retail sales in September, and that should impact the Fed. But we know that the correlation between those consumer sentiment releases and actual retail sales is not always straightforward. Okay, so that's the preview for the week of September 12th to September 16th. Okay, let's see if we have any more questions, and then we'll wrap up this jam-packed show. Luca says, amazing Spain with no government, still one of the best GDP growth rates in the EU. Speaks volumes about national governments in the EU. Well, yeah, Europe is a mess. I don't think I'm really surprising you with that statement. Specifically, many decisions are taken by the Eurogroup and they're not what governments do. Of course, it's harder to impose policy from the outside when there's no government. So in the case of Spain, they were supposed to be punished for fiscal spending by the European Commission, but it was deferred. It was, well, it would be the first time they didn't want to, if the government has a deficit already, you want to punish it with paying a fine, not such a good idea. And it also, but it also shows that with more fiscal spending, perhaps to help elections, it's better for the economy. And it also shows that, well, the stability of European democracies. I mean, you still have a running administration in all these countries, so you don't have any reforms, but things are still moving on smoothly. You can see, yeah, it is amazing. Spain, for those of you who don't know, second round of elections resulted in another hung parliament. This time, the center-right party tried to form a government and failed. Beforehand, it was the socialists that tried to form a government and failed. And the current state of affairs, the country is heading towards a third round of elections in 1 year. According to current law, it will be held on Christmas Day, probably be 1 week earlier, but still the turnout could be low because election fatigue. Anyway, bad politics, but the economy is still growing. Unemployment is falling from very high levels. Anyway, the sun is still very hot here outside. I'm in Barcelona. Okay, third round of elections. Yes, Luca, corrida. Yeah. Luckily, bullfighting is banned in some places of Spain. Ed asks, the ECB limit of buying up to 0.4 bonds be changed as a consideration? Maybe it'll be changed. Yeah, that's an option. I mean, I don't think they will lower the negative interest rate, but they might say, you know what, we'll buy any kind of bonds. If these bonds have yield of -1%, maybe we'll buy them. I think the chances are low, but you never know. There are many people are wary about the ECB that it's running out of things to buy. They began buying these ABS, asset-backed securities, not only to push money into the economy, but also to enlarge the market for ABS. That didn't happen. The market remained limited. Now they're buying corporate bonds. Also, the idea is to push money into the real economy, encourage those same corporations to spend the cash, but also to enlarge the market for corporate bonds. That didn't happen. Okay, there's a big lack of confidence. The amount of savings in this continent is amazing. So there's, on one hand, no investment and lots of savings. To make this money go into action, you need more action from governments and more confidence in general. Okay, all right, let's wrap up the show. Put the slide back on the screen. So this is a quick wrap up for a very busy show on September 7th. The dollar is down. That's the main headline. Forget about rate hike. Bad figures in the US all around. Other things that are going on, oil prices are moving up and down on rumors. Don't expect anything from OPEC nor non-OPEC members. Trump is edging closer to Clinton, and that could mean that markets will pay more attention, especially now as we're gearing up in the presidential elections. No more vacations, volume is high. What does Brexit mean? That's also on the sidelines. And central banks, of course, at the moment don't rock the boat, but this week we have the ECB. So bad figures from the United States are, of course, the ISM non-manufacturing PMI and the Non-Farm Payrolls. These are the main figures. Things look much better in the UK with the winning streak of PMIs. Other figures elsewhere in the world were mixed in Canada and Australia. And Eurozone inflation is a bit weaker. The ECB is the main event of the week. That's tomorrow. Today we have manufacturing output from the UK. Just after the show, UK inflation report hearings, where Carney will probably dodge questions. When you will want to leave the cards open. The Canadian rate decision is held today. No changes expected. I do expect some optimism, because that's what how the Bank of Canada usually portrays. That's how it sees the Canadian economy. Ignore any hawkish talk from Esther George. If Esther George is dovish, do not ignore her, because that will mean is becoming dovish. Watch out also for the US job openings. Tomorrow's ECB meeting. No changes expected in policy. Any change will be surprising, especially regarding rates or the QE program. What we can expect is an extension of the QE program and perhaps some changes in parameters. Perhaps also of high importance is the fresh forecast. If the ECB is more pessimistic about inflation, it could weaken the euro. If it's more optimistic, it could strengthen the euro. Okay, also watch out for the Chinese trade balance for sort of global gauge. And on Friday, for those trading the Canadian dollar, and we dedicated a segment to the Canadian dollar today, that's a very big event, stands on its own, no intervention from any important US figures. And also watch out for the Fed's Rosengren for any hints about Fed policy. He's sort of in the middle. Used to be a dove, but now he's more in the middle. Okay, let's take a quick look at key charts before we head into the sunrise or sunset. Euro dollar on much higher ground, 112.40, which served as some kind of support. Further resistance, 113.35 and 114.20 support, 111.90, 111.15. Cable, very nice rise to the upside, closer to the post-Brexit highs. Support 133.60, followed by 132.50. Resistance, very strong resistance at 134.80. Dollar yen, big move to the downside, especially in the recent Asian session. More to the downside, 170, 100 to the top side, 103 and 104.30. Okay, sort of head and shoulders pattern there. Dollar CAD, very nice technical behavior. 128.30 support, followed by 127.50. Resistance 129.10, 130, 130.80. Aussie dollar moving gap, but struggling all the time. 76.60, 76, 75 lines to the downside. To the upside, we have 77.40 and 77.80. Kiwi dollar, impressive move to the upside at the highest level in 14 months. 74.40 is the current level. Seems a bit unstoppable. 75 is the next level. Support 74, 73.30. Okay. And I guess that's it for a very busy show for today. Let's see if we have last questions here. Yes, I think we do. From Ed. SNB is a good proxy for when to get out of the USA, out of US stocks, as they bought, I think, about 30%. Oh, okay, I didn't know that. Thanks for that information. The SNB is all around markets, buying whatever they can with their Swiss francs too, in order to weaken the Swiss franc. So they have, as you say, a big US portfolio. So yeah, it's worth watching them. Anyway, thank you very much, everybody, for the show, for being here. Wish everybody a safe and successful day in markets. And follow the live coverages on FX3, tomorrow's ECB, and lots of other events. So that's it for today. Thank you very much. And see you tomorrow. Thank you. Not tomorrow, sorry. See you next week, and live coverages of the ECB and other events. So that's it. Thank you, and bye-bye.